first of all, with these yields, the market is saying higher interest rates are coming. They're afraid that the Fed is going to overreact, which it's had a tendency to do over the decades, and push interest rates up too high too fast. I don't think that's going to be the case with Jerome Powell at the chair. He has somewhat more of a business background than most of those on the Fed board in the past, who tend to be more academics. I think he has a greater understanding of what's happening in this economy. I still don't necessarily approve of everything they do, but I don't expect them to overreact here. And I think they're simply trying to normalize rates. 25 basis point increase per time is really very, very mild compared to history, when we used to see 75 or 100 basis point moves at times. So I think the market can absorb that. I think the economy can absorb this. There's also worries about inflation from the tariff war that we're in, and certainly those sectors most directly involved are seeing higher costs, and we're seeing some of that in the data. But when you look overall at the wholesale level and at the consumer level, we've had data out this week showing we're really not seeing that acceleration of inflation data. So I think this is more fear of the market that had a strong run up since late June, and with not really any setbacks, and now the market's doing a setback. But when that happens, and this is the biggest sell-off we've seen since February, when the reasons for that sell-off were, hey, the same thing, same reasons then, and we recovered from that. It took a while to recover, but when doing so, we also saw a sell-off in the commodities, and that has definitely been the case here. The other factor at play is we had zero or near zero interest rates for so long that the more risk-adverse investor, and those at retirement age or close to retirement age, had to go to the riskier equity markets just to try to keep up with inflation. Now, with returns on government securities going higher, the risk-adverse investor has some options. It doesn't mean the economy is collapsing. The data on the economy is still pretty strong. In fact, some of small business optimism index this week was near record high. Consumer sentiment remains high. A lot of the economic data, we've had some data come out in the last week that showed there are sectors of the economy almost overheating. That's not the issue. The issue is what's going to happen in the future with interest rates and inflation, and that's what got the market spooked. But the other factor is these more risk-adverse investors have alternatives. They start pulling their money out of the stock market. That doesn't mean the stock market can't continue to go higher, but it has less money to do so, and puts more of an onus on those corporate earnings to keep up and keep the money coming. And we're entering that third quarter corporate earnings season now, and so far the numbers are looking good. So as we look here at the far right-hand side, and this chart overall goes back to January of 2016, this far right side, we see this big break that we got this week, and we could extend that even lower from today's action. But we're still in this overall uptrend that we've seen since August. Well, since August right here, we dipped down September, but now we're accelerating the upside until this break. So we're going to have to watch and see how this holds. But overall, I think we're going to survive this okay. But these markets do have some headwinds near term.